Today continued to show an interesting divergence between how stocks are moving, how volatility is moving. We're starting to see some interesting charts and patterns developing in the market. It's not your standard grind higher to the upside right now. We've seen these kind of patterns before, so I'm going to break down, what it is, what happens, what do we do, and what do we do in this kind of market environment, especially with stocks some stocks in particular going crazy. But the problem is not all the stocks are going crazy, and some industries are not participating in this last little leg that we've even had here lately. So what does that tell us, and how significant is that? That's going to be the topic of our video today. And then our trade idea is going to be an area that's been a little bit beaten up and battled itself, had its own intermediate pullback, whereas the market hasn't, and now is bouncing itself. So we're going to talk about how to trade that in this environment. So let's go ahead and get started. Today is Monday, August the 31st, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. And you can see a rare down day for the month of August. In fact, it's the first down day we've had in 1, 2, 3, 4, 5, 6, 7 up days in a row. We had about 3 and 5 there, and 4 and 6 here for a stretch where we actually still finished higher during that stretch. That came in between another 1, 2, 3, 4, 5, 6, 7 day win streak. So we'll see if we get a 4 and 6 down day streak here starting with today or not. The near term line, you can see at the time too over here, started the run with a cluster, finished with, the near term line stayed strong all throughout the 7-day streak, and then we had a little bit more of a down day here, but it started a near term decline that didn't end until this move, which started with a cluster, an overbought cluster, and near term line stayed up in the upper reversal zone this whole time. And now we'll see this. The difference here is the oversold line bottomed out. This one didn't really, we finished off of the low of the day today, but still strong intermediate posture. Market sentiment's very strong too. The Dow Jones market sentiment line is rising, as you can tell, getting back closer to 80. Very strong intermediate posture there. More of a decline here now that Apple's not as big of a deal. In fact, this kind of looks more like the down day the S&P had on that last 7-day streak. The Nasdaq Composite continues to blow to the upside, blow out here to the upside. So I have to keep moving that higher. The near-term line up high. Again, the more I move the zero line up, the more the 23% line comes up. Now a 23% drop is not that big of a deal. Below it won't drop nearly the same below, whereas the S&P still there's quite a bit of distance there between the 30-day moving average and the 23% retracement. Not so much on the Nasdaq because it's really pulled away. In fact, it's kind of significantly pulled away from the 30-day moving average. I've shown you this before, but we'll bring this back up. We'll take a look at how far above the 30-day moving average we are right now. Simple moving average here, and you can see over 7%. That's pretty darn high. It's not like a blow off top peak, but you can see we've been pretty darn high this whole time. And some of these other peaks, we came down to zero. We didn't quite go below and get the yellow line, but we came down to zero. And you can see that's, even going out to like the last 10 years, in the last 10 years, we are at, still the 98th percentile. Nothing else even comes close except for maybe this little period in 2010. So quite the rally on the NASDAQ 100 that continues to go forward. We're not seeing that same rally on the Russell 2000, which actually now does have light pink shading again. So it does, it's got a weak bearish posture, still above its market sentiment line, but a weak bearish posture, after an extreme bullish momentum line Friday that almost got us a cluster. Now in the near term line, you notice not really peaking very significantly above the market sentiment line. Now everything is dropping. In fact, everything but market sentiment is dropping here, as the Russell's been really hard. Again, for some context, the Russell's barely above its 78% retracement level, Well, the 78% retracement level for the Nasdaq is right here. So to give you some context, the Russell is about right where my cursor is over here on the right, right here. So that's about where the Russell is compared to the Nasdaq. That's how big of a discrepancy we're seeing in these two indexes. This one being largely influenced by mega cap, since it is cap weighted, and the Russell, which is more of a reflection of broader, economically sensitive type areas and sectors in the market. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked your video today. And number two, you want us to do another video again tomorrow. If you like our videos and you want to let us know, you can do that with one click right now while you're watching with that thumbs up icon. If you don't like our videos, of course, you don't have to click on anything. Also, comment. What did you get out of our video today? What questions or comments do you have? Post those down in the comment section below. Join our website at marketscholars.com. You can click on that link right there in the top right corner of your screen. That will take you to a page where you can subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us on our website here, you can check out other things on the page over here to the right, all our classes that are coming up. You can see our Market Outlook live video here. Again, every day I do the Market Outlook. I also do a live video at 3:30 Eastern Time. You click on this little icon, that will take you to it. It gets both of our premium and our plus subscribers all have access to that, as well as to all of our trading rooms too. Of course, our premium subscribers get access to all that, plus our community and all of our premium tools and resources, including our charting resources. We also invite you to come down here and click on this heart that opens up a new window. Hit that like button right there. Come over here, hit the thumbs up icon. That takes you to your Facebook page. And then hit this like button right there. Again, the more you do that, it benefits us because Twitter and Facebook will promote our content to all of our followers, even if they're not online when these Market Outlook posts get posted. It benefits you because they will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's take a look go back to the charts here, and we can see, I mean, here's our new PPO. So, today's value for this week, we're only one day into the week, of course, but so far we're at 6.88 now. Again, that means the 50-day, the 10-week moving average is nearly 7% above the 200-day moving average. That's how high we got here in 2018. And then if I were to go out further, you can see we got about that high in early 2013. That didn't spark any declines. And we are in a very similar monetary policy environment now, like we were in 2013. We also got this high in 2011, and right before we had months of head and shoulders that preceded the credit downgrade. And then you can see coming off the major lows in 9 and 10, we had a couple drops to the 200-day moving average when we got that high. Over here in 2003, we got that high in the middle of 2004, and then we went sideways for a long time, for months, as we hit the moving average there. So needless to say, it's a very, very high level that we've seen in the last 20 years on the S&P 500 in terms of its PPO. Very, very high. Very strong candle, higher close so far, higher highs so far, and no lower shadows. So very bullish candles. Of course, your Dow, a little bit of an inside candle there. The Nasdaq is showing really bullish, but not your Russell. The Russell continues just to really kind of grind its way, very similar to this. When you kind of go up and you're petering out with these really small inside moves. Now, granted, none of them have been red like those, but it just shows how easy it will be to turn red from this to get these kind of candles like we saw heading into the fourth quarter of 2018. Remember, the Russell actually turned earlier than all of these did, but especially there in 2018 turned earlier. So just something to keep an eye on, that weakness that we're not seeing anywhere else so far, but on the Russell 2000. Let's take a look at the the 3 green arrow chart, and you can see, of course, we got 3 green arrows again. If you take a look at the 2-line versions of this, You can see the stochastics is crossing over, and again, we're still well above the 8 days. So, any kind of intermediate pullback's not imminent, right? Not until you at least see a break of the 8-day, more preferably a sustained break below the 17-day. And that's just not happening. And again, the 17-day moving average is all the way down to 340. That's where that point of control is in the 4-week range. So, where all this volume has been over here, and then we've kind of really pulled up off of this. So keep in mind that if we do break down to that point of control, we will be breaking below the 17-day moving average. The question will be whether we stay there or not, because a break below the 17, you can bounce right off of it and continue to go, and as you saw all these other times. But if you get down there and stay down there, and eventually the 8-day crosses below the 17, and then you break the 30, and we hold that breakdown, that's the stages of a trend reversal. But at least in the very earliest of early stages, you got the MACD rolling over, the histogram rolling back over, with the MACD itself on an absolute basis at relatively high levels. Of course, on a relative basis, when you look at it here with the PPO, which compares apples to apples because of the price changes there. So if you look at it on a relative basis here, which is what this indicator does, down here at the bottom here, let me get rid of the MACD so we can see a little bit better. All right, so you can see we are not as high as we were back there. In fact, you can see here we're pretty darn high compared to these levels, but we're not as high as we were in June 8th when we had that catch-up trade and we peaked there, where we're coming off of the sharp low point there where we typically reverse, have big moves in the other direction to the upside. So we're not there yet, but outside of that move, this area is about where the MACD does get to. Again, outside of those two big moves, because of that big drop, you can kind of see this is about where we get to, and all these other levels. So just kind of keep that in mind. Again, that was at the beginning of a trend. That was at in January of 2018. A lot of people kind of pointing what we're seeing now to what we saw back there. And again, that 23% retracement came very fast and very uncomfortably for a lot of people. I don't think we'll go that far down, but again, just going that far down to the 23% retracement level will be a pretty significant of the total intermediate run, 5-month-long run, will be pretty significant and pretty uncomfortable for a lot of people that have been chasing strong bullish names here in the last week or two. All right, now let's take a look at the intraday moves that we see here, and you can see a little bit. Most of today's weakness occurred very, very late, and is actually continuing just a little bit into the overnight session as well. But keep in mind, again, I've talked about this before. See all that gap there. I mean, there's the point of control, and that's, remember, the 17-day moving average is right about here. So the point of control is just a little bit below that right now. There's not any volume whatsoever because we've gone up so much so fast with so little volume to the upside. There's not a whole lot of volume support now below, and so it makes it very, very easy to come down to these levels. Now, again, would people, is that a pullback? No, hardly, because again, it's not even 23% retracement. 23% retracement is all the way down to 319, and when that, again, there's the 4-week low point, just a little bit above that. So we're getting close to where the 4-week low is, but actually, if you look at it on this chart here, the 4-week low is at 327. So for the 23% retracement to be at 319, and again, that's not a retracement either. That's just noise. So you can go from 0 to 23 very easily, up and down anywhere in that area. It doesn't look like it's noise because we've gone up so much. We've expanded the gap so big, but the reality is that would not be a pullback, and yet more than likely, a move down to 351 here. Even let's say just to 340 from 351, which is where we just peaked. That's a 3% drop. That's going to be a bigger drop than we've seen in a while. In fact, we just haven't seen, if you look at the daily price moves, we haven't had, more. We've only had very few 1% drops since we've really kind of taken off. In fact, look at the gap here between the VIX and historical volatility is just really widening out and setting up for, this possibility for, there to be some more weakness. Watch the gap here if we do get one tomorrow. If it's like one standard deviation, which is close to 2% or bigger, it's actually one standard deviation looks like to be about 1.5%. So if it's right around 1.5% or bigger in the morning, that sets you up for the type of gap that starts these pullbacks. And again, not just a 23% retracement, maybe even a little bit more or so. So that's the type of move that you would expect, and that would be the type of move that would generate a spike in the volatility index. I mean, you think that this is a spike in volatility to go from 21.5 up to 26, but we're still hovering around the 80% mark, which means we're still very low. In fact, what that tells you is the VIX 3M is also remaining very, very high. So what that tells you, there's a lot of room that the VIX can go up. I mean, it can go up just to get to 100%, which is typical for intermediate pullbacks, and those happen quickly. Those happen at the beginning of the intermediate runs, like very beginning of the intermediate runs. That would be a move up to 31 right now, and that's if the VIX 3M didn't move, and we know that's not the case. When the VIX goes up, that goes up too. So you'll see it. We'll probably be up in the mid 30s if and when the VIX catches up to it. And then that will be our spark, right? That will be, it's like, okay, now we're going to have potentially a few weeks here or there of an intermediate pullback. So we're not there yet, but you can kind of see the writing on the wall, so to speak. The volume today, if you notice, was a little bit above the average. Was one of the higher levels of volume that we've had since that down day, where the MACD actually turned red. So a pretty decent amount of volume here at about, what would that be, 65, almost 66 million shares trading hands. If you look at that, and then today's range as well, which is actually below the average. But if you take a look at this in context here of the averages, right there, sorry, then the range is still really small and the ATR is still hovering on the 1% mark. But the volume is more extreme to the downside, the average volume here, than the ATR is. So don't be surprised if we don't start to see a little bit of an increase in volume because of how abnormally low it's gotten. In a situation, I mean, it's one thing to be this low when the VIX is as low as it is, and the ATR over here was at 0.72. On a relative basis. Now we're just barely breaking below the 1% mark here. Let me get rid of that line so we can see it just a little bit better. Remove that drawing. So yeah, so it's one thing to have volume this low, the average volume this low, when the ATR is really low, but the ATR is not really low, and the VIX isn't as low as it was back then. So it just, again, sets you up for, again, a move that you might not be comfortable with if you are too overloaded right now to the bullish side. It's okay to have some bullish trades. I mean, if it's what you don't want to do is get caught thinking, well, man, I'm missing out. I need to really load up on some bullish trades because I'm missing out. Because these last, as we saw in 2018, just to kind of show you an example, as you saw back in 2018 right here, and here, let me change. So annoying sometimes when let me get rid of the high and the low and use the log scale, and we don't need to fit studies. Okay, so you can see, you say, okay, well, in 2018, very similar type move, and we were chasing and chasing and chasing and thinking, oh, I'm just missing out, I better get in here post January expiration. You go in, you go up so much. Well, in a matter of 1, 2, 3, 4, 5, 6 days, you've lost all that move. I mean, that's how quickly you can, especially with this move, because again, if you look at the intermediate run actually started way back here, back in August, and went all the way through there. So if I were to do Fibonacci retracements from where the intermediate run started to where it ended here, you can see how quickly we hit the 23% retracement. And then another. Now, I don't think this kind of a move will happen, but in one more day, we were to the midpoint of the Fibonacci retracement range. A few more days, we were testing the low point. the support of that. So look how much of the move, the rally that we just completely reversed. Just in a matter of just a day. So you get caught chasing in these days here because you think, I'm missing out on all this move, so I'm going to start chasing here, and things are looking good for a few days, and then in a matter of, boom, 5 trading sessions, it's all gone. And then more if it gets worse. And then again, like I said, I don't think that's happening this go around because we're just so bullish and you got so many tailwinds. We were not so bullish. So back in 2018, the safety trade was extremely oversold. Or right now, the safety trade is actually extremely overbought. So I don't think we're going to fall down that much. But I do think, again, yeah, you can get caught, and it can be very uncomfortable if you are overloaded right now trying to chase. Have some bullish trades, but bring back some of the exposure so you're not caught flat-footed, so to speak, when the direction changes. Because it will change. It will be swift. It won't fall off a cliff, right? We won't tank down to March lows, but we can drop to 23% retracement, which is down to 319 very quickly without a whole lot of warning. And so your warning is right now. Right, where the S&P goes up or down a little bit and the VIX jumps up. I mean, we're getting plenty of warning now to reduce exposure. And then we'll hit 23%, like I said, before you even know it. And that shouldn't be a bad thing. In fact, it will actually be a really great thing for a lot of us because then we'll start to get some really good reward to risk ratios like we talked about in Friday's video. All right, so to summarize our technical outlook before we look at some other asset classes here, just a reminder that the trend is strong. The trend is still bullish. It's very overextended according to a lot of different indicators. But and there are some cracks, but it hasn't started the process yet. There's the process of pullback is always a process, and there's some signs that we see if and when we do start that. When we're going to be in, and we haven't seen that yet. Not even the initial signs. So while there are some cracks out there, and while there are indicators showing how overextended we are, it can stay overextended. It got to this point by being overextended, relatively overextended for quite a while, even just to get to this point that we're at. And we're not even still yet 5 months. We still got a couple weeks to where we can actually complete 5 full months of this intermediate run, which we've seen happen before. So we can have another week or two for all we know, but we do know that volatility is already starting to rise. So that's a red flag, and that's just a reminder from the markets that don't get caught chasing these big returns and runs over the next week or two, as we saw in 2018 especially. They can be reversed very, very quickly, and it can be very painful for anybody who's getting in late. Right now is not the time to increase exposure to these really volatile but really bullish areas. Now is the time to actually start decreasing our exposure, not to 0%, but decreasing from what they were. So what do you think? Do you agree with that assessment? Do you disagree? Comment in the comment section down below, especially if you disagree. What are you seeing that you would like to share with our community? What chart or indicator would suggest why you're a lot more bullish or a lot more bearish than I am? All right, now let's dive into what's driving a lot of the price action here today, and just take a look at. Look at that big. QQQ. There's your driver right there. Really from this low point right here, there was a brief little downturn. But from that low point that essentially we hit on August the 11th, if I were to come out here, custom to August the 11th, and take a look at how things have been going. It's actually need to go to, I guess, August the 12th. Let's go one more day. There we go. So there's the gap up. There's the close higher. Actually, that's the gap up on August the 12th. Did we gap up on August 12th on the Qs? Let's see here. Take a look at, is it this one? Nope. Let's take a look at this. Let's take a look at the QQQ on August the 12th. Yeah, so we did gap up. A little bit of a kind of a runaway gap at that point that we haven't filled in yet, even though, again, a move to the 23% line would fill in that gap as well as the gap from August the 17th that we haven't filled in yet either. A couple runaway gaps. So So if I were to go back to here, then you can see from that low point, from that day, from the August 11th close, the Qs are just killing the S&P 500. And gold is doing well too, and gold and commodities with this drop in the dollar and drop in long-term bonds. So you're finally getting a little bit of a tailwind from a selling in bonds. If you go back to like this chart here, let me take a look at the market forecast chart for TLT. Look at the dark pink shading and the red line. So there's this is actually August the 6th that it peaked after getting this cluster, and then there's August the 11th really that we, again, that's when everything gapped up. It was actually August the 12th when everything gapped up. But you can see bonds are already starting to fall, and we've gotten oversold clusters, but we got dark pink shading and a red line. That's on the daily chart. But if you look at the weekly chart, the weekly chart's actually giving us a pretty good bullish candle, except for one thing, pattern, except for the fact that the near intermediate line is crossing down below the market sentiment line. It did it over here too, but we weren't close to the moving average when it did that. Over here, we got this pattern after it had been well below the market sentiment. The market sentiment line. Here we're getting it at the same time that we're crossing the market sentiment. And remember, all these bearish moves, dark pink shading and red lines, always start with a light pink shading and yellow line first. You can see over here we got it to this pattern at the same time we were crossing below, or just a little bit above there. So it's a sign here that this might be a light pink shading and yellow line, that instead of like this one where we bounce up to new highs, we actually roll over and start working our way back down now to the downside, back towards this Fibonacci retracement zone, potentially all the way down to the bottom of the Fibonacci retracement zone, which would be a pretty significant move for yields, which you can see down a little bit here today. But when you look at it on a one-year basis, getting that cluster that we got on Friday, that's a good sign that getting a cluster at the beginning of the intermediate run is a good sign for the potential of that run going forward. Here's the Euro US dollar. Euro up a little bit, so the dollar down. That's helping fuel a lot of this rally too. A lot of this rally that we've had. And again, there's the June 8th peak right there. So we had that big push was also fueled by weakness in the dollar. Then we got this little pullback, and now the latest push has been fueled by weakness in the dollar. And we'd expect that any continuation of long-term moves will continue to be fueled by any weakness and long-term weakness in the dollar that we might have. As you can see, the intermediate line on the weekly chart way up above its market sentiment. So lots of opportunity for this to stay bullish here for a while, even if we do get kind of an intermediate pullback here to 23%, if not 38%, during any kind of intermediate pullback we get in stocks and risk appetite as a whole. One more thing to look at too is the commodities. That's been a chart we've been kind of paying attention to as it's been grinding its way higher. The commodity ETF, if we take a look at the Bollinger Bands for that, you can see, again, very little path of least of resistance to the upside, all the way to you get to 15.5. That's 2 points away. That doesn't seem like a lot, but 2 points on $13.50 is well more than 10%. Right, $1.35 is 10%. So it's a pretty decent move still on commodities left to come. Especially with the weakness in the dollar, and we might get a little bit of a pullback and fill in some of this spot, which would really build up a very strong support level for it, and actually would get rid of some of this volume and even open up more space that we can go up to the upside again on any kind of intermediate pullback. But you can see the potential for commodities as a whole to continue to rise to the upside. I've also brought up in the past this idea of inflation expectations. So here is the current level as of Friday of inflation expectations. Well, it's the highest that we've seen in the past year, or close to the highest that we've seen in the past year. It was higher, just a smidgen higher here in December before things kind of really hit the fan, and really hit the fan there. But over here we were forming a divergent high in stocks, and this was falling. And then again over here in in September of 2019, we were at this level. If you go back 5 years, you can kind of see how fast and rapidly these inflation expectations are moving up, and the trend line, if you were to draw a trend line coming down here that we've broken to change the trend from falling, from when this, again, the bear market, the stealth bear market started in early 2018 when these inflation expectations peaked. It really kicked into gear in October or September of 2018, and we've been on a downward trend ever since. Very similar to a regular bear market, but thanks to FANG, we didn't get one. Well, now you can see the trend has changed, and we're getting a upward trend. The last upward trend we got was from early 2016 all the way up to that point where markets were bullish for a while. And so we're kind of seeing a similar pattern developing here. All right, if we take a look at the sector moves and how they've performed here, let's get back to this chart and take a look at how they performed. Let's actually go to that same August the 11th, August 12th low point. So let's go to the comparison first, and then we'll take a look at that same August the 12th here. From when the NASDAQ really took off, and you can see it's been, XLK, XLC, XLY. That's we're living in their world right now. Energy stocks struggling, utilities, financial stocks are actually down from that point. Industrial stocks are flat from that point. The broad market's up 5%. You got staples that are up 3%. You got healthcare, which is, again, it's got some growth elements, but also some safety elements as well. Along with materials, and so really your kind of economic sensitive areas are all either down or up just a smidgen, and your cyclical areas, your tech areas, are doing very, very well, and they're leading the strength. They will continue to lead strength. I believe they'll continue to lead the strength after all is said and done. But they also have the kind of weakest margin of safety out of all the other sectors. If and when we get an intermediate pullback, you can see they're by far the furthest away from their moving averages. You can see financials are just barely above it, healthcare just barely above it, staples a little bit further, industrials and materials is barely above it, and energy barely above it. So you can see they don't have nearly the extent to fall just to get to the moving average as XLK, XLY, and XLC does. And this actually real estate, energy is over here. So again, it's a margin of safety concept, and this, as great as this leadership has been, and while you should have some exposure there, and we do, like in our class portfolio, we don't have nearly the same exposure as we did. And you just have to kind of keep in mind and remember that if you've been in these areas for a long time, you've got some great gains. It's okay to get back some of those gains and still maintain the trend. But if you're just now getting in thinking, I would like to get some great gains going forward from here, then just be prepared, because they have the weakest margin of safety. They'll have the most room to fall again and still be on a bullish trend, right? And not be even trend changing because of how much they moved. In this case, so far away from their respective 6-week moving averages. All right, that brings us to our trade idea of the day. And it's actually in the consumer kind of discretionary space, but it's this Shake Shack. Look at the intermediate run that it's just barely starting. So it actually did get its own intermediate pullback, again, with an oversold cluster. We've seen this kind of pattern on a lot of stocks. Starting a new intermediate run itself, came really close to a cluster right there on that day, where the near term line finished at 77.5. Everything else was above. And you can see market sentiments rolling up, and market and intermediate line well above it, so lots of room for this to grow too and to run. But it's been very, very bullish. It's the run it's gotten to get to this point is been pretty strong. You can see it's you've got some volume at the top of the value area here. You've got some very strong support down below where we're at. If you take a look at its RSI indicator, you can see it's got a very extreme RSI all the way up to 80. You look at its DMI indicator, you can also see extremes on the DMI with it getting up to up above 40 in the positive index, well below 10 on the negative index. So it limits the upside potential a little bit when you're up this far. You can see just barely getting above 5 and above 80. So good strong trend well up above the green and the blue lines for that matter. And you can see the red line also well up above the price too. So, when you get to these levels, quick kind of mini parabolic move, you can see it's MACD is really high. I mentioned in the Market Outlook live video that its PPO is also really high. Then you say, okay, well, I don't want to short this. It's got a strong trend. It's got some good potential. But I also don't want to necessarily go long either at this point. So what we looked at instead of doing is doing both, going long and short on this by doing a short put spread at the 60-55 levels and doing a short call spread at the 80-85 levels. So what that ends up doing is it sets up this for room to go to the upside as well as room to the downside. Remember, there's lots of support in this area right here, so very easy for it to stay up where we need it to stay. But if it does keep going up, lots of room to work with to the upside. And you can see where those lines show up on the chart. They show up right here. So there's the room to the upside for it to go through the value area. And then again, you've got a big volume node above the break even on the downside and a big volume node right below it too. So an opportunity for it to hold and bounce off of that support if we were to get a little bit of weakness here. So that's how we trade that. And again, you can see we're going for about a $500 gain for the normal position size, because earnings most likely will end up being after October expiration. And then again, with that $525 reward, that's how much we're willing to lose. So I don't want to lose the whole 975, but out of that, we'll be willing to lose 525 because we can make that back up with another iron condor if and when needed. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen to go to our website, specifically to go to our Market Outlook forums. Open up any new thread there on that message board, reply to anybody else's thread, and let's keep this conversation going among our Market Outlook viewers here in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon on Twitter and Facebook too, and also comment down below as to what you got out of the video today, what questions or comments you have. Thank you. Have a great rest of your Monday night, everybody, and we'll see you all next time.